So in today's video, I'm going to walk you guys through my high probability Apple options trade, the reasons why I've done it, my order entry details, and all of that kind of good stuff. So if you like these trade ideas or live trading videos, please smash that like button and don't forget to subscribe because I want to do more of these type of videos. So let me know if you want to see more of my live trade videos. That being said, what I have open is the Tastyworks platform. Now, I don't place my trades on Tastyworks, and the reason why I'm showing you Tastyworks is because it's visually a lot better than the broker I actually use, which is Interactive Brokers. Now, I'll show you the screenshot of the actual trade and all of that kind of good stuff from my Interactive Brokers platform. But again, I'm using Tastyworks just to kind of show you, because I think it's a better platform visually for me to shoot these videos for you, as well as it's got some really cool indicators on there that I like to use. I've linked Tastyworks down below if you are interested in opening an account with them. So why have I chosen Apple? So as you guys know, I like to sell options to generate premium. And when we generate premium, that is pretty much our maximum profit that we can make for the trade. So what we want to do is we want to be placing trades where we can pick up the highest amount of premium we can for as little as risk as possible. Now, one of the ways to do that is using what's called the IVR rank. And what the IVR rank is, and I've got it on Apple on the screen at the moment, and what it looks at the highs and the lows of every single day. This is a daily chart of Apple of the implied volatility measured against the last 52 weeks. So what it's saying here is that the current IVR of Apple, and you can see it on my watch list side, I've got Apple over here, is 92.1%. So what that means is the current implied volatility is at the highest it's ever been, and it's in the 92% percentile over the last 52 weeks. Now, as a rule of thumb, I like to use an IV rank of greater than 50. That's my personal method. A lot of other traders use it above 30. But that being said, the higher the IVR, the more the option premiums are going to be. And as you can see over the past, throughout December, the IVR has been going up. And the last time it was the highest it was recently was around October the 13th. And you can see here, even if you just draw an average across here, we are trading above its higher range. And the reason why we want to trade at high implied volatility, as I've said, not only do you get higher premium, but IV is a mean reverting tool. So eventually, as you can see here, volatility has been going up and down. Eventually, when IV goes down, the option prices that we have sold are going to be a lot cheaper to buy back. So that's the first rule I like to look at. The second thing I like to look at is the IV percentage. What this is saying is that the current implied volatility of Apple has closed below the number. So the current implied volatility of Apple is at 45%. Apple has closed below 45% implied volatility more 94.5% of the time. So it doesn't happen that often. And you can see that here. So if I draw, the high it's ever been, we've got 1, 2, there's 3, 4, there's 5 peaks throughout the whole of last year, potentially 6, depending on where you're counting, where implied volatility has been higher than that current point. So again, this is setting up as what I like to call a high implied volatility situation. And as you can see, over the last 5 days, volatility has been going up, as you can see here visually from the graph. So that's why I like to use this as my kind of fundamental basis. So I have all of these stocks, to be honest, are pretty high volatility rank here to kind of trade. So you got your Amazons, your Metas, your Googles, your Teslas, your Netflix, and all of these kind of trades that I'm currently in at the moment, because the market is going low. As you can see, Apple is down 4 points today, and it's a pretty bearish move. So this is why I want to place this trade. Now, the trade that I placed, and if I go over to the trade tab, so obviously we are trading options here. First go into the expiration. The expiration that I choose is always between 30 to 60 days. 45 days tends to be the sweet spot, and it just happens to be that the 17th of February expiration is 45 days away. And that's what I've got to pick. So I pick the 45-day expiration. And what I like to do when I have a delta neutral position, i.e. I don't have a directional bias on Apple. Apple can go up and I can still make money. Apple can go down and I can still make money. And what I've decided to do is go with the 10 delta for Apple. And what does that mean? That basically means that Apple has a 9% chance. We've got the in the money percentage here, so it's 11% chance, at 9 to 11% chance of the Apple stock price being below $100 at the day of expiration. And that's what that means. So when you sell a strangle, you sell a call, you sell a put, and you sell a call. And I'm looking at the 10 delta. So in this example, it was the 9 delta. So the current price here is around $1 you would collect in premium. On a call side, again, I'm looking at the 10 delta, which is here, and the in the money is at 7% over here, and that is at the 150 strike, and that is trading between 68 to 69 cents. So you can see here with the put option around the same deltas, the risk is more on the downside because the option price of the put is higher than the option price of the call. And you can see here when you set this position up, we have a credit, mid-price credit of $1.70 or $170. Now, the key things here that I want to show you, if we look at from a curve perspective, so if Apple stays between 100 and 150, that is my profit zone. Now, the next question is, what is my break even? So I go back to the table side, it has the break evens on it. Your break even is your strike minus the credit you receive. So it is, what's that? 100 minus 170 in this example, 98.30 on that side, and it's 150, 170 on the upside. Now, break evens don't really make that much of a difference unless you're holding to expiration. So I'll go on to how I'm going to manage this trade in a second, but the order entry, we're looking at the 10 deltas. So high probability we're going to be out of the money. 89% on the calls put side, and 92% on the call side. So a high probability trade, and you can see the probability or the pop, as it's called on the Tasty Bets platform, is 83%. The extrinsic value is $169, and the probability of achieving at least 50% of the max profit in this example to achieve $85 is at 93%. Now, for those who've been watching my channel for a while or even more recently, know that I like to take my profits at 50%. I do have a good to close order at 50%. Again, we'll go through the screenshot of what I actually got filled at in a second. And you can see here the delta, currently slightly short delta here. But effectively what we want here is this to be as close to zero as you possibly can. My theta is around $6 a day, max profit 170. Max loss is infinite because, Apple, I could get assigned these options, or Apple could go to zero, all these other different things inside there. But this is where a lot of people get hung up on the max loss, right? So, I could lose potentially 15 grand to 10 grand on this trade for $170 odd. What you've got to understand here is you've got to understand the probabilities that are inside your favor. And again, this only really matters if we're holding this position to expiration, which we won't be. Buying power effect, this is a cash account, so this is not really true refraction. But on my IBKR account, which is a margin related account, the buying power or the margin is a few $1,000s. So if you look at return on capital, we just do 168, which is what it's trading at now, 168. Divided by, it's around 2,000. So it's an 8.4% return on capital. So that being said, again, how am I managing this position? The first thing, I've got a good to close order at 50%, which is, again, a 95% probability chance it will do. The next step is to manage this position at 21 days. Now, I'll do it slightly before 21 days because Apple has earnings. I think it's January 26th with it, which is 23 days away when you work it out. I did the math earlier, but it's around just before earnings, which is around that 21-day sweet spot. I will look to manage this position. So if I have a small loss, like a 10-cent loss or something along those lines, I'll just close out of this trade. If I've got any profit on the board, I will close out of this trade. The only time I will roll this forward into the next expiration, so in this case it'll be March's expiration, is if we still have a high IV rank, and we might have that due to earnings, but generally I do not roll into an earnings cycle, just what I do because of the expected move that might be in there. The next thing is the expected move of this expiration date. One of the reasons why I like Tasty, it calculates this for you based on various things. They use 3 metrics and take an average of it. The expected move is plus or minus $12.60. Let's call it $12.60. So with the current price at $125.66, if we add $12.65, we're saying on the high side, we are looking at $138. Now, our call's at 150, so we're well out of the expected move. Again, which is why you have a high probability of profit and a high P50. On the downside, we're looking at 113, and we've got the 100 put here. So again, you've got another 13% of downside that is needed for this particular trade. And I'm not even taking into account volatility potentially dropping or deflating, that's the right word, to drop down these option prices as time goes on. If we look at how much money I actually made on this position, you can see here I sold the 150 calls, what we talked about. I got 77 cents for it, or $77. And then I also sold the $100 put, which I made $91 on. So if we add the two numbers together, it's at 168. And if we go back to here, it's trading still roughly around the same price as what I got filled out, which is good. And I've got a close at 50%. So I've got a good to cancel order to buy back this whole strangle for 84 cents or for $84. So my plan on this is very simple, is do nothing until I hit my 50% profit target of 84 cents, $84, or one of my strikes get tested. I'm not going to go into in this video what happens if one of my strikes get tested, because the next step is then to adjust the position. If that happens, I will do another video about me adjusting this position, but for now I'm keeping it where it is there. So I really hope you've enjoyed this video, and I shall see you guys in the next one.